Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're tackling the ongoing condo market meltdown in Toronto, which shows no signs of stabilizing. Steve, it seems like the market's been in a downward spiral for quite some time now.
You're right, Janine. The situation has been deteriorating for a year and a half, and the outlook isn't improving. The Toronto Regional Real Estate Board reported that condo prices in the Greater Toronto Area hit a 4-year low by July, with a 9.3% drop from the previous year, and a staggering 21% decline since February 2022.
That's a significant drop, Steve. It's concerning to think about the impact this has on potential buyers who might be hesitant to enter such a volatile market.
Exactly, Janine. The cuts to international student programs and reduced immigration have led to fewer new arrivals, which typically drive rental demand. Investors are also pulling back, viewing the market as too risky. And let's not forget the influx of new supply, with many of these new condos being the tiny, so-called dog crate units that aren't exactly appealing to most buyers.
It sounds like a perfect storm, Steve. Buyers are understandably cautious, especially with reports of pre-construction condo buyers being caught off guard by falling prices and scrambling to make up the difference when lenders won't meet the agreed mortgage amounts. It's a tough situation for anyone trying to navigate the market right now.
Absolutely, Janine. Joel Fox from Own Right mentioned that despite the price drops, many units still seem overvalued due to the significant appreciation during the ultra-low rate environment of the COVID-19 pandemic. And even if interest rates align with expectations, it might not be enough to spur a rebound.
That's a concern, Steve. It seems the market needs to reach a point where prices and incomes align better before we see a turnaround. Until then, buyers might remain wary of getting trapped in a souring market.
And let's not forget the broader economic factors at play, Janine. TD economist Rishi Sandhi suggested the market might see some improvement in 2026 if interest rates decrease and trade tensions ease. However, the chances of a dramatic rebound are slim, and prices are expected to continue slipping this year.
Thanks for that insight, Steve. It's crucial for our listeners to stay informed about these developments, especially if they're considering entering the condo market. We'll keep monitoring the situation closely.
Janine, it seems Canadians are facing a lot of uncertainty when it comes to mortgage interest rates. A recent survey by TD highlights how divided people are on the future of these rates. This division is causing confusion and making it tough for home buyers to make long-term financial decisions.
Absolutely, Steve. The survey shows that while 32% of Canadians expect rates to climb, 27% are anticipating cuts, and 29% think rates will hold steady. With no clear consensus, it's understandable that many are feeling pressured and unsure about locking in a rate now.
That's right, Janine. The lack of agreement on rate directions illustrates the challenge for those renewing or signing a new mortgage. Locking in a rate today could mean paying more in the future or missing out on potential savings if rates drop.
And it's not just the rates themselves, Steve. The survey also points out that economic pressures, such as tariffs, are influencing mortgage decisions. Nearly 1 in 3 Canadians say tariffs have directly impacted their mortgage strategy.
Exactly, Janine. Tariffs are affecting borrowing capacities, with 31% of respondents saying tariffs have impacted their ability to borrow, and 28% reconsidering taking out a mortgage because of them. This underscores the complexity of the current market.
It really does, Steve. And while some recent home sales data suggests slight improvements in affordability in major markets, many potential buyers are still hesitant. They're waiting to see how these broader economic factors play out before making a move.
Jason Mercer from the Toronto Regional Real Estate Board mentioned that promoting domestic economic growth could help mitigate trade uncertainties. He believes that further interest rate cuts could spur home sales and positively impact the economy.
That's an interesting point, Steve. It highlights the interconnectedness of economic factors and the housing market. For many Canadians, having access to expert advice is crucial, as 88% of survey respondents indicated the importance of professional guidance when making mortgage decisions.
Absolutely, Janine. Even with a strong general awareness of the mortgage process, surprises like unexpected costs can arise. The survey found that 23% of Canadians encountered unexpected expenses during their mortgage journey.
It's a reminder of how vital it is to seek personalized advice, Steve. For anyone navigating this uncertain market, understanding both current affordability and personal risk tolerance is key to making informed decisions.
Let's shift gears to talk about CIBC's latest earnings report. The bank saw its net income rise to $2.1 billion, an 11% increase from last year. But what's particularly interesting is the context of this growth, especially given the rising mortgage arrears in Toronto and Vancouver.
It is quite a juxtaposition, Steve. While CIBC is posting higher profits, the reality for many homeowners in the Greater Toronto Area and Greater Vancouver Area is becoming more challenging. Mortgage arrears are climbing, which points to financial strain on households.
Exactly, Janine. The bank's 90-day mortgage delinquency rate rose to 0.36% in the third quarter, up from 0.33% last quarter. Despite this increase, CIBC's Chief Risk Officer Frank Guse reassured analysts that the bank's credit portfolios remain resilient. He attributes this resilience to strong equity buffers and low loan losses.
It's reassuring to hear that the bank feels confident about its portfolio's health, Steve. But for individuals, especially those in regions like the Greater Toronto Area where the delinquency rate is at 0.44%, these numbers reflect real financial hardship. It underscores the importance of having a solid financial plan in place.
Absolutely, Janine. The bank is also seeing strong results in its Canadian personal and business banking sectors, with a 17% year-over-year increase in net income. This improvement is driven by higher net interest margins and volume growth, which speaks to CIBC's strategic focus on relationship-driven banking.
And relationship-driven banking seems to be working for them, Steve. Chief Financial Officer Rob Cedrin highlighted that nearly 80% of CIBC's mortgage clients have a checking account with the bank, and 93% have at least one additional product. This approach not only builds deeper client relationships, but also supports the bank's profitability.
That's right, Janine. This strategy is quite similar to what we're seeing from other big banks like Scotiabank. By focusing on comprehensive client relationships rather than just competing on price, CIBC is enhancing its margins. This approach appears to be paying off, as evidenced by their 47% stock rally, making them Canada's fourth most valuable bank.
It's a reminder of how interconnected financial strategies are, Steve. While the bank is thriving, it's crucial for those who are experiencing financial difficulties to seek advice and explore options. The rising delinquency rates are a signal that there are still significant challenges in the housing market, particularly in high-cost areas.
Shifting our focus now to the currency markets, there are some noteworthy developments involving the Canadian dollar. Recently, the loonie has hit a 6-day low against the United States dollar. Janine, this movement is largely due to a combination of factors affecting both global and domestic economic conditions.
That's right, Steve. The Canadian dollar is facing downward pressure as investors are weighing the prospect of a potential interest rate cut by the Bank of Canada later this month. The market is currently seeing about a 50% chance of a rate cut, which is an increase from 40% just before the release of recent economic data.
Exactly, Janine. The data in question showed that Canada's economy contracted more sharply than expected in the second quarter. This contraction has fueled speculation about the central bank's next move, especially considering the global rise in long-term borrowing costs. It's a challenging time for the loonie, as investors are also reacting to broader economic concerns, including fiscal deficits.
And while the Canadian dollar is under pressure, it's interesting to note that its decline isn't as pronounced as some other major currencies. This is partly thanks to the recent increase in oil prices, which have settled 2.5% higher. As oil is a significant export for Canada, this helps to cushion the loonie's fall somewhat.
That's a good point, Janine. However, we should also keep an eye on bond yields. Canadian bond yields are tracking higher alongside U.S. Treasury yields, with the 10-year yield rising by 8.5 basis points. This steeper curve reflects the broader trend of rising interest rates, which tends to strengthen the U.S. dollar.
Absolutely, Steve. It's a complex picture. And for those of us in real estate and mortgage sectors, these currency and interest rate shifts can have significant implications. From the cost of borrowing to the competitiveness of Canadian exports, it's vital to stay informed about these trends.
And as we wrap up today's episode, it's clear that the economic landscape is continually evolving. Whether it's the fluctuations in currency or the potential for interest rate changes, staying informed is crucial for making sound financial decisions. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.